Welcome to the latest episode of Quest for Twice. Last week, Ingredient and IEC reported the latest quarterly earnings. So in this episode, I would like to review the result. As a reminder, Ingredient makes core and specialty food ingredients. The core ingredients are commodities used for animal feed and corn oil. However, its specialty ingredients are much more interesting and I believe are in line with the future health and nutritional needs. So that's really the driver behind my investment. Its latest quarter gross margin was about 22%, so same as Q3 and up from 21% 1 year ago. So that's holding up very well. And its forecast of 2021 sales would be modestly up. If we look at the year-on-year quarterly sales comparison in 2020, we could see that in Q1 there was a modest sales growth of 3%. Then the pandemic hit, a 9% drop in Q2, and a bit of recovery in Q3, still minus 2% from 1 year ago. But in Q4, it has increased sales to 4% increase from 1 year ago. So it's a classic V-shaped recovery. Now its Q4 results are better than 1 year ago without the pandemic. So Ingredient really has a growth story behind it. If we look at the pie charts on the top right, that's the ingredients growth plan for its specialty ingredients. And so that's a percentage of specialty ingredients sales from 25% of total in 2015 to 30% in 2019, and plans to grow to about 35% in 2023. So in last year, its specialties percentage was 32%. It's well on track to meet its goal in 2023. And because of the specialty ingredients have a higher margin, so its earning growth will be faster than its sales growth. Last month, I reviewed the opportunities and threats to the ingredient business. So let's take a look at the updates. So let's update the two of them based on the latest quarterly results. So the Cost Smart program launched in 2018 is well on track to reach its goal of $170 million cost saving. So last year, cumulatively, it has saved $100 million compared to 1 year ago. So its future growth will be at a lower cost and a higher margin. And also after 2021, the restructuring cost should come down to almost zero. And once those one-time charges are removed, we should see a nice bump to its earning. If we estimate based on last year's results, that should be about 14% of earning per share. A risk I identified last month was inflation could reduce profit margin because its input materials are corns and other bulk material. However, based on the latest quarterly results, it gross margin actually increased by 100 base points compared to 1 year ago. So despite the fairly significant food inflation we saw in last year and continue in 2021, so this risk is under control. And the strong US dollars can reduce ingredient sales and profit. And based on the consensus from the Wall Street, the US dollars likely will enter a long-term bear market and will weaken on multi-year basis. So that actually will be a tailwind to make ingredient business more robust. Its capital allocation plan for 2020 was significant capital investment with the dividend payment, and there'll be free cash flow after dividends and capital investment. Actually, it spent $753 million in 2020. That's because of a significant merger and acquisition cost of $242 million. That's almost $200 million more than it spent in 2019. Given that it's doing merger and acquisition in the downturn, I believe Ingredient actually got a good value from that investment. So I'm happy with the increased M&A investments. Its capex investment was also a little higher than planned, and I'm okay with that. And the dividend was $178 million. The reason I believe it's good for Ingredient to invest heavily in its business was because of its return on invested assets were over 10% from 2019 results. That's despite the restructuring cost I mentioned earlier. And also, since it's investing in its specialty segment, which has a higher ROIC, then the return on its organic capex in last year and maybe the year before should have a higher return than 10%. So its 2021 capex budget is $330 to $350 million. So that's in line with the 2020 investment. So I would say that's almost half as its annual cash flow, and that's a heavy investment into its future. So I do believe there is a growth story for Ingredient to play out. So what's the investment thesis? It's really about the attractive valuation with modest risk and getting the growth story for free, because it's adjusted EBITDA from last year was almost $900 million, and based on the current market cap of $5.6 billion, its EV to EBITDA ratio is about 8.2. So that's significantly undervalued, even without the growth story behind it. So by that metric alone, we can say it's undervalued. Then if it has some growth working out for Ingredient, then I believe that ratio should expand significantly to above 10 for sure. Another way to look at it is to look at the forward PE ratio. So if its 2021 earning recovers to 2019 level, its forward PE will be about 13. That's lower than the average PE ratio for S&P 500. And that's without counting the benefits from a cost smart program. As a result, I believe it's an attractive investment with modest risk and good growth potential you are getting for free at this price level. Now let's take a look at the latest IEC quarterly results. Its Q1 revenue grew 6% from 1 year ago. So that's quite a bit slowdown from its annual rate of 22% growth. Even in 2020, its revenue growth was 16%. So 6% can be characterized as disappointing. And its aerospace and defense and the medical segments revenue grew, while the industrial revenue declined year on year. Its management explained that the revenue disappointing growth was due to COVID-related employee absentee. Basically, because of rampant COVID, so a lot of employees were asked to stay at home based on the exposure from contact tracing. So its capacity was not fully utilized in Q1. And the management restated that its quarterly revenue goal of greater than $50 million stay intact. As a result, I believe the disappointing Q1 result was a one-time phenomenon. IEC will likely recover. Its quarterly gross margin was at 12%, comparing to 14% in 2019 and 2020, versus 12% in 2018. So that was a regression. Its quarterly operation margin also declined from before. Lastly, just to note that its growth plan is on track with the significant investment in Q1 into new office and facilities for $27 million. To put that in perspective, its annual depreciation cost is usually $2 to $3 million. So that's a huge investment in new office and facilities, and I believe that shows the confidence of the management in its future business prospect. Let's just review its investment thesis and the risks. The thesis is really to buy a fast-growing company at a reasonable price. It was $15 on February the 8th. And the risks is that it's a very small company, so rely on a handful of major customers, and if lose one major customer may have a significant impact on its revenue, hence profit. It also relies heavily on the aerospace and defense sector. With the new Biden administration, there is a risk that the new administration will shift its budget focus and may or may not affect the revenue from the A&D sector. Now we also know that it suffered disappointing revenue growth in last quarter. Will it be able to recover if the management is right that the most recent quarterly growth deceleration was due to COVID? Then it should be able to, but there is some uncertainty there for sure. Thanks for watching another episode of Quest for Twice. Until next time, happy investing.